I'm Alan Kenny, Editorial Director with REIT.com, and I'm at NAREIT headquarters in Washington, D.C. for the latest edition of Fundamentally Speaking with my colleague Calvin Schnure. Calvin, give us an idea of what's going on with the jobs market. Sounds like we got some pretty good news with the latest report.
That's right, Alan. The numbers we got were that non-farm payrolls rose 248,000 in September. Now that's a solid number just by itself. And also, prior months were revised upwards, so the weakness late summer was not quite as pronounced as we had thought before. A lot of things we can take away from this. One, we've seen a shift in the tenor of the data from what we had a year, 2 years, 3 years ago. Early in the recovery, anytime we had some strong news, a month or two later, there was a stumble, there was a setback, a summer pause. Well, we're still seeing some choppiness in the data, but it's flipped. Anytime we have a weak month, next month we have stronger numbers, upward revisions. We're seeing the economy's gathering momentum, gaining speed. Now this is going to be quite good for the economy because it shows we still have the potential to generate a lot of jobs. That's good for commercial real estate, not just for the office sector, but for the places where people are spending their money, in retail, in apartments. This is overall good news for the real estate sector.
And Calvin, one of the big stories in the news is interest rate policy. How does this latest news about jobs and the strength of the economy affect the outlook there?
This news is likely to keep the Federal Reserve on track. One thing that they've made clear is that they intend to unwind all of what they've been doing. They're going to continue tapering their bond purchases. They're likely to raise interest rates next year, sometime starting in the middle of 2015. The exact month is going to depend on what's going on in the economy. That's what we should expect. But they've made clear two things. One is they don't want to keep these extraordinary policies in place. The other is they don't want to take them away too fast. So what's likely to happen is we're going to see moderate interest rate increases during the year. They're not trying to put in a tight monetary policy to slow the economy. They're just trying to get us back to neutral to let the economy continue to grow. Now, a lot of people are asking questions about what does this mean for commercial real estate. As they let the economy continue to grow, we're going to see rising occupancy. This is going to support rent growth. This is going to support earnings and FFO. So commercial real estate should be able to thrive in the type of interest rate environment that the Federal Reserve is going to engineer for us.
All right, can you give us an update then on what the commercial real estate market's doing right now?
Right now, the third quarter was a moderately good quarter. We haven't had really robust economic growth, and we're seeing some new supply coming in. So we're seeing continued gains in absorption. We're not seeing a lot of declines in vacancy. Actually, the vacancy declines have stabilized a little bit right now, but we are seeing continued rent growth. One exception here is the multifamily sector, which is still continuing to be quite hot. We haven't seen further declines in vacancy, partly because it's quite low, but we're seeing solid rent growth there. So we're seeing a good, solid set of fundamentals for commercial real estate as we go into the fourth quarter.
All right, well, thanks for your time, Calvin.
Thanks for having me.
And for more on this and other real estate news and analysis, be sure to visit REIT.com.